Welcome back to the GoldTime Tracker, your go-to channel for everything gold and silver. I'm Dennis, and today we're diving into a day that silver investors will not soon forget, the infamous silver flash crash of 2025. If you're holding silver or even just curious about the market, this video is packed with crucial insights because what happened today isn't just a simple price drop. It's a story of extreme volatility, margin chaos, and potential institutional fallout. Let's start with the numbers. Silver opened the day at 82.67 per ounce before tumbling to a low of 70.21. That's a swing of over $12 per ounce, roughly 15% in a single day. To put that in perspective, it's a roller coaster ride, the likes of which we rarely see in precious metals. But this isn't just about the numbers. It's about why this happened and what it means for investors like you. The alleged trigger: CME Group's increase in margin requirements for silver futures. This move forced leveraged traders to either meet higher margin calls or liquidate positions, creating a cascade of selling that rippled through the market. But here's the kicker. While futures prices dropped sharply, physical silver demand remains extremely strong. Major bullion sellers like SD Bullion and Money Metals are running out of popular bars and coins. For example, 100-ounce silver bars, which were available just yesterday, are now sold out. Smaller bars are trading at premiums of $77, $79 per ounce, reflecting scarcity and strong buyer demand. Meanwhile, rumors are swirling about banks and institutions. Some reports claim that a systemically important bank faced a margin call crisis and may have received emergency liquidity from the Federal Reserve. Whether true or not, these stories highlight just how interconnected silver, major financial institutions, and global liquidity really are. The takeaway? Silver volatility impacts not just traders, but the broader financial system. Today, we'll cover it all: the extreme swings in silver prices, the tension between paper futures and physical bullion, and the potential implications for megabanks like JPMorgan Chase. By the end of this series, you'll understand not only what happened today, but how to navigate the ongoing volatility strategically, whether you're buying physical silver or trading futures. The key factor: CME Group's decision to raise initial margin requirements for March 2026 silver futures to $25,000 per contract, a jump from $22,000 just 2 weeks ago. This move, combined with reduced position limits, forced leveraged traders to liquidate their positions rapidly. What we saw was a cascading sell-off that sent futures prices tumbling from 82.67 down to 70.21 per ounce in mere hours. Think about it. A 15% intraday swing in a market that is normally considered relatively stable is extreme. But here's the interesting part. While futures prices were plummeting, physical silver demand stayed rock solid. Major bullion dealers like SD Bullion and Money Metals are reporting low inventory and high premiums on smaller bars. For example, 1-ounce bars are selling for $77, $79 per ounce depending on the dealer, while larger 100-ounce bars are completely sold out. This demonstrates a critical point. Physical silver is finite and can't be conjured out of thin air like futures contracts. This divergence between paper and physical silver highlights a growing tension in the market. Futures prices reflect leveraged trades and margin pressures, while physical silver shows true supply-demand dynamics. China, for instance, continues to see strong premiums, indicating that real-world demand for industrial and investment silver remains robust. Now, let's touch on the rumor mill. There's chatter that a major bullion bank may have faced a margin crisis, possibly receiving emergency liquidity from the Federal Reserve's repo facility. While these reports are not confirmed, they underscore how interconnected silver, megabanks, and global financial stability truly are. Essentially, what happens in silver can ripple through the system in ways many retail investors may not fully grasp. So, what does this mean for you as an investor? First, don't panic sell. Physical silver is still scarce, and while futures volatility may shake traders out, strong hands can capitalize on the pullback. Second, shop wisely for silver. Different dealers offer different premiums and inventory, so understanding the landscape can save you money. Finally, keep an eye on technical levels. Today's lows could represent a support zone, a floor for those looking to enter the market strategically. The rumors swirling around major bullion banks have intensified as we examine the mechanics behind the silver flash crash. Some reports suggest that a systemically important bank faced a margin call it couldn't meet, potentially triggering a liquidation of its silver short positions. Early claims indicate that the Federal Reserve may have intervened through its repo facility with an emergency injection of billions to stabilize the situation. While these reports are not fully confirmed, they highlight the enormous leverage and risk inherent in the silver futures market. It's crucial to distinguish between paper silver, which can be bought and sold in massive volumes with limited physical backing, and actual silver, which remains scarce. The recent price swings emphasize that paper markets can move violently without reflecting the real supply constraints of physical silver, especially as demand continues to rise for industrial and investment purposes. Looking at the US markets, the volatility is staggering. Silver prices swung roughly 15% in a single day, creating significant losses for leveraged traders while simultaneously triggering buying opportunities for those focused on physical metals. Across different bullion dealers, the supply of 100-ounce bars is nearly depleted, with 1-ounce bars still available, but at premiums that vary widely between retailers. This is a critical lesson for investors. Knowing where to buy, understanding the premium structure, and recognizing inventory levels can make a huge difference in timing and cost. Even as futures markets tumble, physical silver is being snapped up quickly, signaling that long-term demand remains strong. The situation becomes even more complex when examining the interplay between US and Chinese markets. China continues to report high premiums on silver, and its pricing often sits above US levels after conversion. This indicates a persistent global appetite for physical silver, driven by industrial needs and investment demand, particularly for green energy and advanced technology applications. While Western paper markets react to margin calls and speculative positioning, the East is signaling that the physical market fundamentals are stronger than ever. This divergence between futures and physical markets is creating tension that could persist for months. And investors need to understand that short-term technical crashes may not reflect long-term physical scarcity. Amid this turbulence, the role of large financial institutions cannot be overlooked. Banks taking large short positions are exposed to enormous risk, and when volatility spikes, even a single misstep can cascade through the market. Historical parallels, like the 1980 Hunt Brothers episode, remind us that markets with finite physical supply can experience sharp squeezes, with banks and leveraged traders facing significant losses. At the same time, these events can be opportunities for strategic buyers who focus on the long-term value of physical silver rather than chasing short-term paper positions. The key takeaway is that volatility is a feature, not a bug, in precious metals markets, and understanding both physical supply and institutional behavior is essential for navigating this environment effectively. The focus now shifts to the role of major banks, particularly JPMorgan Chase, in the unfolding silver saga. Reports indicate that the bank may be on the hook for delivering thousands of tons of silver it doesn't physically hold, a consequence of aggressive short-selling strategies. Essentially, JPMorgan bet that silver prices would fall, intending to buy back contracts at a lower cost. However, the recent surge in silver prices has trapped them in a massive short squeeze, with potential exposure in the tens of billions. This is where the distinction between paper silver and physical silver becomes critical. While futures contracts can be manipulated or leveraged, physical silver is finite, and as demand continues to rise globally, especially for industrial and green energy applications, banks attempting to cover shorts face increasingly limited options. Simultaneously, the silver flash crash has exposed vulnerabilities in the system, particularly the opaque operations of the repo market. The Federal Reserve has quietly been injecting billions into the banking system, providing emergency liquidity to stabilize banks facing short-term losses. This underscores the interconnectedness of the banking sector and the precious metals markets. While it's impossible to know every detail of these interventions, the magnitude of liquidity injections suggests that regulators are prepared to prevent systemic failures. For investors in physical silver, this should be reassuring. Even in the face of extreme volatility, the long-term fundamentals remain intact, and opportunities to buy at discounted levels often emerge during these market shakeouts. On the technical front, silver's recent price movements signal more than just short-term panic. Analysts observe patterns consistent with outside bear bars, indicating that further downward corrections may follow before stabilization. Market behavior over the coming 10 days is likely to reflect two legs of sideways to down price action. Yet, this technical volatility doesn't diminish the value of holding physical silver. Investors who focus on the fundamentals, scarcity, industrial demand, and geopolitical factors can view this volatility as an opportunity to accumulate rather than a reason to sell. Understanding the difference between short-term market theatrics and long-term value is crucial for navigating such turbulent periods. Global dynamics further complicate the picture. Eastern markets, particularly China, continue to exhibit high physical premiums, suggesting that the true scarcity of silver is increasingly evident outside the West. As industrial applications expand, including technologies like advanced EV batteries requiring significant silver content, the supply-demand imbalance is poised to persist. This divergence between paper futures and physical demand is a growing feature of the market, creating both challenges and opportunities for investors. Those who recognize the broader macro trends can position themselves strategically, ensuring that temporary price drops are leveraged to acquire real silver at favorable levels. The lessons from recent events emphasize risk management and awareness of institutional behavior. Banks exposed to extreme volatility may trigger rapid swings in futures prices, but these moves rarely reflect the underlying value of physical silver. For retail investors and long-term holders, the key is patience and strategic accumulation, focusing on physical holdings rather than attempting to time every short-term fluctuation. Volatility will continue to be part of the silver market, but informed investors can turn these turbulent periods into profitable opportunities, particularly as global demand for physical silver remains robust and largely unimpeded by speculative paper markets. As we move deeper into the silver volatility story, attention turns to the regulatory actions that triggered the recent flash crash. The CME Group's decision to raise initial margin requirements for March 2026 silver futures caught many traders off guard. By increasing margins from $22,000 to $25,000 per contract, a jump of nearly 14%, the exchange forced leveraged positions to either be liquidated or fully funded. This sudden liquidity drain sent silver prices tumbling from recent highs to lows around $73 per ounce, reviving memories of the infamous Silver Thursday of 1980. The immediate impact was most severe in paper futures, where speculative positions were vulnerable, but the ripple effects extended to global markets and created a stark divergence between paper and physical silver pricing. This divergence highlights a critical aspect of the silver market. While futures can be manipulated through margin adjustments and forced liquidations, physical silver remains finite. Eastern markets, particularly China, continue to show high premiums for physical metal, reflecting robust industrial and investor demand. For those tracking silver's global flow, it's clear that supply is not meeting demand, especially given emerging technologies like advanced electric vehicle batteries that require substantial silver content. The discrepancy between futures pricing in the West and the physical market in the East underscores the structural imbalance, providing opportunities for investors who focus on tangible holdings rather than speculative paper contracts. Technically, analysts are observing price patterns that suggest more short-term volatility is likely. Silver's recent bear bar movements point to potential further declines before a consolidation phase sets in. This could translate into a period of sideways to downward movement over the coming 10 days, where short-term traders may see swings of several percentage points. However, for investors in physical silver, these fluctuations should be viewed as buying opportunities rather than causes for panic. The market's fundamentals, global demand, limited supply, and increasing industrial applications remain strong, making current dips attractive for accumulation. Looking forward, there is significant potential for silver to test new support and resistance levels. Analysts suggest a floor around $72 per ounce, while upper levels may climb rapidly if Eastern central banks and industrial users continue to drive demand. These movements are compounded by geopolitical factors, monetary policy, and inflationary pressures. The CME can manipulate futures and raise margins to slow a rally, but it cannot create more physical silver, meaning the underlying supply-demand dynamics will continue to dominate over the long term. Investors focusing on these fundamentals can navigate volatility confidently, using technical dips as strategic entry points. As we wrap up this in-depth look at the silver market, it's clear that the recent volatility is not just a short-term anomaly, but part of a larger structural shift. The flash crash, driven by margin hikes and speculative liquidations, has exposed the fragility of paper futures markets while simultaneously highlighting the strength and scarcity of physical silver. For investors, this creates a unique environment. While short-term price swings may appear alarming, they are opportunities for those focusing on tangible holdings and long-term fundamentals. The divergence between paper and physical silver, particularly in Eastern markets, signals that industrial demand and technological innovation, especially in areas like electric vehicles and advanced batteries, will continue to underpin silver's intrinsic value, independent of speculative activity in the futures market. Looking ahead, technical analysis and market behavior suggest continued short-term fluctuations, likely extending over the next several weeks. Prices may test support levels around $70 to $72 per ounce, but the overall trajectory for physical silver remains bullish, supported by ongoing industrial demand, geopolitical uncertainties, and global inflationary pressures. Savvy investors can take advantage of these temporary pullbacks to accumulate physical silver, positioning themselves strategically for potential gains as markets stabilize. Meanwhile, major financial institutions and central banks continue to influence liquidity and risk management behind the scenes, but these interventions do not diminish the fundamental importance of owning physical metal in a constrained market. It is also essential to distinguish between trading for short-term profit and investing for long-term wealth preservation. Paper contracts and leveraged positions can provide quick gains but come with significant risk, particularly during periods of extreme volatility like we've witnessed. Physical silver, however, offers a tangible hedge against inflation, currency devaluation, and systemic financial risk. Understanding this distinction is crucial for navigating both current market conditions and the anticipated developments of 2026. Investors should approach the market strategically, using technical insights to manage risk while keeping their focus on long-term accumulation of high-quality physical silver. Financial disclaimer: the information provided in this series is for educational and informational purposes only and should not be construed as financial, investment, or trading advice. All market opinions expressed are based on analysis and personal experience, and there is inherent risk in investing in precious metals. Always perform your own research and consult with a licensed financial advisor before making any investment decisions. The GoldTime tracker, Dennis, and all contributors disclaim any liability for losses or damages arising from reliance on this content. Broader macroeconomic considerations amplify the significance of silver's movements. Central bank interventions, repo operations, and liquidity injections by the Federal Reserve signal that systemic risk remains closely monitored. Yet, these actions primarily stabilize the financial system rather than dictate the intrinsic value of silver. For savvy investors, understanding the difference between paper market volatility and the real physical metal market is essential. While the next few weeks may see continued swings, the broader trend points towards scarcity-driven strength in physical silver, especially as global industrial and technological demand accelerates. For those who stay patient, this volatility is not a threat. It is an opportunity to position for the year ahead.